Hey, good morning, everyone. I'm Greg Barron, President of the RCEDC Board of Directors, and it's my pleasure to welcome you to our second quarter Leadership Council meeting for 2022. I'm really excited about today's session. I think it's going to be an excellent discussion. First, I just want to do a check that all the Leadership Council members have received their meeting materials via email. Just make sure that you review that material. There's excellent information included in your leadership package, and look specifically at our quarterly results against our strategic plan, the 2021 audited financial statements report, which was just presented earlier this morning to our board, our current financial statements through February, and minutes from our last meeting. If you have any questions at all about any of the material, don't hesitate to reach out to Jenny Trick with any questions, comments, or concerns. So starting last year, we opened our Leadership Council meeting to the public. We did this because it provides another opportunity and touch point for us to inform the business community about relevant topics. In October of 2021, we focused on industrial development. At our February meeting, we focused on talent attraction and retention. And today we're going to dive into business funding solutions. We'll have three guests joining us this morning who will introduce in a bit, but it's my pleasure to turn the podium over to Carolyn Engel, who is RCEDC's Business Finance Manager. Carolyn, over to you.
Good morning. I am happy to have the chance to address the RCEDC Leadership Council and our business community. My remarks today will include Racine County demographics, workforce composition, in and out migration, and business financing solutions. The population of Racine County, estimated to be about 197,000, has increased over the last few years. In the last 5 years, we have added 1,575 new residents. Our population is projected to grow by another 2,200 residents over the next 5 years. Our growth pattern in the region varies by county, as you can see in this slide. Racine County's population characteristics include about 36,000 millennials, ages 25 to 39. The national average for this area, the size of Racine County, is 40,350 millennials. Retirement risk is above average in Racine County, with 62,900 projected to retire. Racine County has 12,000 veteran residents. This is above the national average. Who lives here now, and from where did they come? From the most recent data in 2019, nearly 1,500 people left Kenosha County and moved to Racine County. In that same year, 1,460 people left Milwaukee County and moved to Racine County. Waukesha and Walworth counties are also sources of new residents, as were Lake and Cook counties in Illinois. These same counties are often the destination of Racine County residents as well. So the borders are fluid and people move around the region for a variety of reasons. Our goal will be to continue to promote job opportunities in the greater Racine County website and work with developers to build more housing in Racine County. Racine County is also home to a healthy base of businesses, both by size and industry type. Wisconsin and Indiana battle it out each year as to which state has the highest concentration of manufacturing jobs. So it comes as no surprise that our largest industry is manufacturing, followed by healthcare, government services, and retail. With all of the construction and business park development that's occurring here, it's no surprise that the top growth industries are construction, transportation, and warehousing, followed by professional occupations in management and professional and scientific fields. In addition to sorting businesses by industry, companies can be segmented by employment. According to the census, nearly 60% of Racine County businesses are small, or referred to as first stage companies with 2 to 9 employees. Nearly 20% of our businesses are second stage companies with 10 to 99 employees. As you can see from the graph, this is the sector that has the majority of the employees. This is true to Racine County and across the U.S. Research has shown that this stage is the fastest growing, both by employee count and by revenues. Of the 95 projects RCEDC assisted in 2021, 41% were first stage and 52% were second stage. The remaining 11% was third stage or larger. As a financial service provider, we want to understand the composition of Racine County businesses, but we also want to understand how businesses fund their growth at each stage to see if there are gaps that need attention. There are many options from debt to grants to equity. On the left side of the graph, you will see commercial lenders and term loans, but you'll also see RCEDC and business lending partners. Commercial lending is typically structured as 50 to 75% debt with 50 to 25% equity required. When your commercial loan is structured in conjunction with RCEDC's financing, a company's down payment is reduced to 10%, and the monthly payment is reduced after factoring in RCEDC's low interest loans. Before I move to the right side of the graph, I want to mention a few more points of interest. First, RCEDC has a number of community loans and grants to support first and second stage companies. Specific to grants, we have some limited funding available in both the Racine County Matching Grant Program and funding still available in Union Grove and Burlington's grant programs. For our community loans, one of our most popular programs has been the Zero Loan Program. Its popularity is largely due to its 0% interest rate, limited fees, and no payments until July. There are other community loan programs as well as the SBA products that our staff can help you with by emailing one of our loan officers. But today we're going to focus on the right side of the graph, equity financing. We are thankful there are several partner organizations that support Wisconsin businesses in this space. Today, we're going to explore venture capital. So at this time, I'll turn the mic back to Greg, who will introduce our guest speakers.
Great, Carolyn. Thank you so much for presenting an overview of Racine County's background and the existing financial resources available to our community. Now I'd like to transition to our panel discussion. And let me start by introducing our speakers. Andy Walker and Chris Eckstrom are with Rock River Ventures. Andy has made a career as an operator and investor in data-driven technologies. Most recently, Andy was CEO of Channel IQ, acquired by MarketTrack, which performed e-commerce channel management analysis for manufacturers and retailers. Prior to Channel IQ, Andy founded 426 Solutions, which was acquired by Computer Science Corporation. Andy is now a partner at Rock River Capital Partners, where he invests in disruptive technologies in the Midwest. So welcome, Andy. Over to Chris. Chris is one of the two founders of Rock River Capital Partners, which manages a $27 million venture capital fund based in Madison that launched in late 2018. Rock River Capital Partners invest in early stage tech companies located in or are willing to relocate to Wisconsin, exhibiting high growth potential. Chris moved back to Madison from Chicago in 2015 with his wife and 3 young children. He previously ran the Chicago principal investment team of Macquarie Bank, which deployed over $2 billion capital in the US and Canada. So welcome, Chris. Now, our third panelist this morning is Greg Robinson of 4490 Ventures. Greg is managing director at 4490 Ventures, which is a venture capital firm focused on investing in early stage software companies that are connected to proprietary assets such as data, analytics, and hardware. Greg has over 2 decades of operating and venture capital experience. Prior to 4490 Ventures, Greg spent over a decade at Peninsula Ventures investing in early stage software companies. Before joining Peninsula Ventures, Greg was a co-founder of Cogent Technologies, which was ultimately acquired by Brightstar. So welcome, Greg. Now, we certainly have an impressive lineup of speakers this morning. As a reminder to our audience, our team will be watching the chat function at the bottom of your screen. So please feel free to submit your questions, and I'll take a peek now and again, and we'll be able to draw on our audience for some great questions. So let's start with some foundational information, especially for those of you who are less familiar with venture capital funding. So here I'm going to have a drum roll here as we move into our discussion. And Chris, I'm going to start with you. You're going to kick us off this morning. Can you give us an overview of the venture capital industry? What is the source of funding? Who are the major players, such as entrepreneurs, investment bankers, investors, and others? So I know that's a whole big topic, but Chris, why don't you kick us off?
Well, I think so. Venture capitalists. So Andy and I are partners in Rock River. Venture capitalists in general are entrepreneurs, are investment bankers, are investors, are successful business people who have decided to go raise capital from pension funds, from institutions, from corporations, from high net worth individuals. And we as venture capitalists use that capital we've raised to invest in startup companies with the goal of return to our investors. So this is early stage, high risk, high return proposition. So our investors, we sort of say we're going to double, triple, quadruple their money. We're sort of looking for a 5 to 10x return. So big returns. And this is, you see the startups, the Facebooks, the Googles, when people invest $1 million, they get 10 million back, something like that. So high risk, high return. Some of the players, it's I don't know, Drive Capital, back Andy's company. They're a multi-billion-dollar VC in Columbus, Ohio. They're ex-Sequoia venture capitalists. The venture capital industry really started and kind of got going on the coast in Boston, San Francisco. So a lot of the big players are, the names, the Goldman Sachs of the world, the Benchmarks. So I was just doing some stats. So there's about 1,000 venture capitalists in the U.S. right now that are active. So 1,000 firms like ours that are investing. And in 2021, they invested $329 billion in the U.S. So, fair number of firms out there focused on high growth investments, where we can put $1 in and get $10 back. And knowing that every deal we do is not going to be successful. So we're looking for, some to exit and some to return capital, but knowing that many will fail.
Chris, when you're looking at these high returns, the ROIs that you're mentioning, what type of time frame are you looking at generally?
Yeah, so ideally the time frame is as quick as possible, but the reality is some of these investments will take 5, 7, 10 years to return capital. And that's sort of why when you put in $1 million and you get $10 million back, it might seem like a great return, like 10 times your money. But if you look at the IRR, the rate of return, it's 10, 15, 20% rate of return, which is, still really good.
Well, these investors are patient over a window of maybe up to 7 years.
Yeah, exactly. So a lot of the investors in venture capital are pension funds. So SWIB, State of Wisconsin Investment Board, is a great investor and has hundreds of billions of dollars of capital. But they also have a long time horizon, so they can put a portion of their investment in venture capital and wait it out over 10 or 12 years. And 10% to 25% IRR is really good for their pot of money, for instance.
Great. Well, thanks for getting us going here, Chris. So let's bring in Greg. Greg, can you talk to us a little bit about the profile of a typical company that might consider raising venture capital? What type of companies are we talking about?
Yeah, so it's probably worth noting that the vast majority of businesses out there should not be raising venture capital. They just don't fit venture capital. That's fine. Venture capital, as Chris alluded to, is a very specific targeted, product or industry. And, very few companies actually fit into what venture capital is looking to do. So most businesses are companies that can be better suited getting funding in other manners, whether that's debt, whether that's, bootstrapping the businesses. But businesses that end up fitting the venture model are companies that have extremely high growth. And, I think from our perspective, these are companies that on a variety of different measures can, get up and going fairly quickly, prove out that they've got a product that people value, people want to pay for, and then they need a lot of money to be able to scale that business. And so these are businesses that can go, in the early days, double, triple, quadruple in a given year, and we'll do that year over year for a number of years because to get to the returns that Chris was talking about, you really do have to see this incredibly high growth. And so as a result of that, there's a couple of industries that fit very nicely into those types of businesses, things like software that can scale very quickly, very easily, very efficiently, things like life science, deep tech, things that have a lot of IP or some type of advantage that allows them to scale very efficiently, that allows them to be protected over time, whether that be legally or just from a business model perspective. But in the end, what venture is looking for and what we're focused on more than anything is a very large problem or market and a company that has a product that can scale very, very quickly. I think it's worth noting that conventional wisdom in the venture capital business was that there were, call it 5 or 6, maybe there's more these days, maybe it's 10. But there's between 5 and 10 companies each year that are founded that really matter, that really drive the returns for the industry. And so that kind of gives you an idea of, we're looking for the fastest of the fastest of the fastest growing companies. And, the ones that grow pretty fast are good investments. But what drives the industry and what really gives venture capital its name are the companies like Facebook and Google and all the big, great tech companies that you see out there. But those are, there's only a handful of those that get created every year. And those are the ones that we all look for.
Great. Thank you for that, Greg. I'm going to jump back to you, Chris. Andy, you're on deck, so you're up next. So, Chris, can you comment a little bit on the demand for venture capital funds versus the current supply?
Yeah, I'd say so the demand, I think there's a ton of demand for venture capital dollars. As Greg alluded to, a lot of that demand are companies that we struggle to invest in that don't kind of meet the high growth, high return, double, triple every year characteristics. So that being said, we have a database of companies we've looked at, and Andy and I have kind of been doing this for 4 years now, primarily in Wisconsin. I think we've looked at between 800 and 1,000 companies in Wisconsin, startups that are looking for venture capital dollars. And as of now, we've got essentially 12 companies in our portfolio. So that hit rate is pretty low. So a lot of companies looking for dollars, but we're sort of selective in finding the characteristics that make a good venture capital investment for us. They're hard to find.
Okay, Chris, you've done a nice job setting up my next question here. So Andy, over to you. I was noting in your bio that you referenced the fact that Rock River Capital invests into early stage tech companies that are located or willing to locate in Wisconsin. Mm-hmm. My question is, does your firm only invest in Wisconsin-based companies? And if that's the case, why is that?
Yeah, so on our first fund, we raised a pretty small fund. If you look at the size of our fund, it's about 27 million. By national standards, that's considered a nano fund. It's not even a micro fund. It's extremely small. So in venture capital, you have to create essentially diversity in your fund, and you have to do that by spreading that money out. So if you have $27 million, you don't have that much to spread out. We can't go nationwide. It's even tough with that small of a pool to even go regional. So that's one reason. But really, the main reason is that we are a part of the Badger Fund of Funds program. That program was funded by the state of Wisconsin in 2013. So about 38% of our capital came from that fund, and because of that, our entire fund is regulated to stay in the state of Wisconsin. So we thought that with a small enough pool of capital, we could deploy it all here. We also had somewhat of an altruistic side to it. Chris and I are both from Wisconsin. We both moved out of the state to further our careers. And we really feel that Wisconsin has the characteristics that we need, but it doesn't have enough capital being invested. So there was some altruistic side, there was some regulatory side, and there was also just some mathematical components to it.
Great, thank you for that, Andy. So Greg, in terms of comparison versus what Andy was just saying, can you tell us a little bit about 4490 venture investment criteria? That is, what's your deal in terms of limiting investments in Wisconsin?
Yeah, so much like Andy and Chris, I mean, venture capital is sort of a hands-on business, and so obviously from just a practical perspective, you like to do everything as close to home as possible. There's just advantages for doing that. So we're very focused on trying to invest as much as we can in Wisconsin, and we actually did move one company back to Wisconsin, and would love to do more of that if we could. Our focus is clearly to do as much as we can here in Wisconsin, but we have a little bit broader mandate where our thesis is that there's lots of places like Wisconsin that are underfunded, and so we look at kind of neighboring states to Wisconsin and kind of the Midwest in general. They're all kind of, back to your question of what's the demand for venture versus what's available, they're all kind of underfunded. There's clearly way more entrepreneurs than there are dollars, which is kind of the flip of the script in terms of what happens in the Bay Area and New York and Boston, where there is a lot of great entrepreneurs, but there's always 10x the amount of money there that is really needed. So there's a lot of fighting for investment. So we're very much focused on trying to deploy as much money as we can in Wisconsin. But for what we do and what we're looking for, we found that we kind of think we'll try to deploy anywhere from 30 to 40% of our funds probably in the state, and probably the other greater half or so kind of in neighboring states.
Great, thanks, Greg. Before we dig deeper, I think we need a little bit of a primer here, a kind of venture capital 101 lesson. So Chris, I'm going to pick on you for a second. Can you give us a little bit of detail around venture rounds, pre-seed, seeds, A, B, C? Can you kind of get us all on the same platform on what that nomenclature means?
Sure. So I think when venture capitalists are making investments, we are primarily making minority investments into companies, these startup companies. So we're not, investing more. We're not taking control. We're not taking 51%. So it's minority investments. And then, so typically, I think Greg touched on it, but there's ways to fund companies. So when startup entrepreneurs fund companies, they can self-fund. They can get friends and family to invest. Typically, venture capitalists like to come in after there's, I guess generally in Wisconsin, we've seen the first kind of capital, outside capital, is sort of $250,000 to $500,000, and those are sort of pre-seed rounds. Those are really early. If you think, obviously a seed, a garden analogy, you kind of prepare the soil as a pre-seed round, and then as a company progresses, they raise larger and larger rounds of capital. So you go from a pre-seed to a seed. A seed round might be a $1 to $2 million investment into a company. The company continues to do well, continues to grow and exhibit characteristics that venture capitalists like. Then they'll raise an A round, and an A round might be $2 to $10 million. So as you go down, A, B, C, D, the rounds typically get bigger, and the valuations that the companies raise that capital, those minority investments, get larger. So the pre-seed round might value a company at $1 or $2 million. And then an A or B or D, all the way down might be tens of millions, hundreds of millions of dollars toward exit. It could be a M&A opportunity. A big company might buy out the company after the B round, C round, D round, or a company might go public. That's sort of the liquidity event we're looking for. So it's the spectrum of raising capital at greater dollar amounts of capital, and then also at higher valuations typically.
And I think Chris, the important part is to know that like the coasts are different from, like, the dollar amount could vary drastically based on geography too. So whatever
Andy,
you're seeing in Wisconsin could be 10 times more there.
So Andy, is it are we just talking financial capital, or some investors, is there intellectual capital that gets involved in any of these rounds, Andy?
Yeah, I mean, in general, you should be looking for both, right? Obviously, they're injecting, financial capital, but usually you want something else to come with that capital. So every fund usually has some sort of specific focus. So with that focus comes some expertise in that area. So some funds are extremely software related. That's all they do, and they'll actually get more focused and say, "I'm only doing healthcare software." Greg Bakken in the state of Wisconsin is a good example of that with HealthX. Then you'll find some funds that are only biotech, or they are only life sciences. Venture Investors in Wisconsin is a well-known biotech and life sciences investor. So what you'll see is these very specific verticals that every fund focuses in. And with that, they bring a lot of expertise. They have access to experts in that area. They have access to potential customers in that area. And they also just have a lot of domain knowledge themselves from working in that field for so long.
So,
And I'd say so. So I'd add on that as well. That venture capitalists, it's more about it's sort of a combination of the capital, but also the expertise. We are partnering with entrepreneurs. We're partnering to help build these companies. Typically, we're sitting on the boards. We're providing expertise or mentorship, all that sort of thing. It's the capital, but it's also the experience. And part of Andy and my kind of starting a fund and moving back to Wisconsin is helping provide that expertise, the capital plus the expertise to create great startup companies.
Okay, so you talk about these rounds and getting in. Triggers the exit. How do you plan the exit strategy?
You want me to take this one, or
Sure, yeah, Andy, why don't you jump in?
So, I mean, there's two ways to think about this, right? There's two schools of thought. One school of thought is start with the exit in mind, right? The other school of thought is build a great company and somebody will want it. There's an exit in and I'm of the second thought. I think starting with the exit in mind can potentially lead to short-term decision-making and maybe not necessarily build a company for the scale that you could potentially achieve. So my opinion is just build a great company, focus on the fundamentals, focus on the market dynamics, start in a large market, understand your market, and make sure it's big enough to scale a large company. That's what the best advice I think I ever got in the venture capital space is you can change just about everything about a company other than the market. If you start in a small market in a niche space, there's nothing you can do. You're always there. So my opinion is build a great company and there'll always be an exit in your future. Don't worry about it.
Okay, thanks, Andy. Greg, it looks like you are nodding along with that. So I'm going to go over to you now, Greg. Can you tell our audience a little bit about the different types of venture capital groups? Like some are funding other VCs, some are dealing directly with entrepreneurs. Can you give us a little feel for that landscape, Greg?
Yeah, sure. I mean, the origin of venture capital is kind of early stage hands-on investors, and that was kind of the original model. And then as the industry grew, there's all kinds of kind of on-ramps and additions that came to the business. And so there's on the early stage side, there's folks that can provide all kinds of interesting services that are kind of accelerators or some type of launching apparatus like Y Combinator, or here locally there's Generator that do things like that. There's very late stage groups. There's all kinds of kind of new groups that provide liquidity and additional capital for businesses when they become large and substantial. I think the other thing that is probably happened over the last 20 years or so is just as more folks tried to get into venture capital, getting access to guys like Andy and Chris, sometimes it's hard for whether it's individuals or smaller entities or pools of capital to actually get into funds. And so there are other vehicles where you can pool capital through some type of an aggregator. Sometimes that manifests itself in the form of a fund of funds, which has been around for a while and serves that purpose. Now there's a lot of kind of what they call multifamily offices or other types of aggregators that allow kind of wealthy individuals or wealthy families to pool their money into a vehicle and give them access to multiple funds and just helps them get access to the asset class. Because originally this was a very much a cottage industry. It was very hard to get access to, very hard to know who's doing what. And, as it's grown, the transparency and access has grown. And so there are a number of ways now for people to participate in the asset class. But like I said, most of the folks that are, considered venture capitalists are still kind of the traditional model of, relatively small group of individuals, very targeted in their strategy, deploying, relative to the broader markets of a small amount of money. We invest in kind of, hundreds of thousands, if not millions of dollars, typically increments, whereas the market, is typically dealing with hundreds of millions or billions of dollars. So it's still a fairly small piece of the financial ecosystem, even though when we have big wins, it ends up driving huge returns and kind of be a big part of the ecosystem that way.
Greg, I'm going to stay with you for a second. And Chris and Andy, I'm going to ask the same question I'm going to ask Greg. So you'll be up next on the same question. Greg, can you tell me a little bit about the general sources of your funding and compare and contrast to what the industry might look like?
Yeah, sure. So we're a Series A fund, which, Chris mentioned, we kind of are one step behind Andy and Chris. They invest in the $1 to $2 to $3 million seed rounds. We invest in those, kind of $5 to $10 million Series A rounds. And we have about $100 million of capital that we're deploying. Most of our money is made up of, of dollars coming from public pensions, endowments, foundations, and then kind of probably more increasingly, more so kind of family offices. And so these are still fairly large pots of capital, but these are I would say the underlying kind of characteristics that kind of all of these things have in common and I think Chris mentioned this, is like it's patient capital. So these are folks that they don't mind. In fact, they like when their money is tied up for 5 to 10 years, as long as it's providing a very good return, because what they're focused on is a multiple of their capital being returned. And so all of our capital sources tend to be and really need to be, long-term thinkers, very much focused on being patient capital. Because even though we'd like these things to be kind of quick growing, even if they're quick growing, the great companies take 7, 10, 12, sometimes 15 years to really manifest themselves. And so you really do have to be patient, even with your winners. And so I'd say, our capital sources are fairly traditional in the sense that they're, pensions, endowments, and foundations, but there's more and more money into the industry, and it's coming from kind of more and more disparate sources.
Great. Thank you, Greg. Hey, Chris and Andy, can you tell us a little bit about your sources for your company?
Yeah, I can kick off and Chris can fill in. So because we are a smaller fund than Greg, we're more of a pre-seed or seed fund. Our source of capital is less institutional and more high net worth. So about, I mentioned that about 38% of our funds came from the Badger Fund of Funds, which is somewhat of an institutional pool of capital. Then we have a couple of other institutions in as well that make up kind of the 50% of the total capital. So the other 50% is all high net worth. So really what that means is there's accredited investor rules in the United States that define, if you can invest in this asset class. So an accredited investor, you have to have a certain net worth, or you have to have a certain annual income to legally be able to invest in this asset class. And that's because it is a high risk asset class. They don't want people, sticking their 401ks in these traditionally. So 50% of ours is high net worth people and 50% is institutional. I think it's important to know that Chris and I are two of the larger investors in the fund. And I think that that's important for people to know. We're not just deploying other people's capital. We have a huge chunk of our own capital at risk here. And that really makes sure that we have skin in the game.
Great. Thanks,
Yeah.
Andy.
I just added that to it for the high net worth accredited investors. This sort of falls into alternative asset class. This is a small portion of their portfolio. So given that these are people worth tens of millions of dollars that are putting $100,000, $200,000 checks, $300,000 checks into our fund. So it's a risky return asset class that is a small portion of somebody's greater portfolio typically.
Thanks for that, Chris. Greg, back to you. For a business that gets involved in this, what's the cost of the venture capital? In terms of like ownership and control. What are the other issues that you'd have to think about in terms of the cost of venture capital?
Yeah, I think that's a really good question. And so first of all, it's expensive money any way you look at it, and whether you're talking about seed rounds, the early ABC rounds or even growth rounds. I mean, all of this money is, however you want to look at it, relative to debt, even expensive debt. Equity is very expensive, and so you have to be very, very confident that it's something that you really want to do, you need to do, and there's going to be a return on that investment. And so, I would say that typically in a seed round, again, it does vary whether you're on the coast or you're in the middle part of the country, because the amount of dollars and valuations change quite a bit. But on any given round, you're probably selling, at least, I'd say on average 20% of your company. And you could potentially have multiple rounds, so you can start to see where a fair amount of your company will be sold to your investors, and so your percentage will be dramatically reduced. And so you have to be very comfortable that you're going from 100% ownership to down to 80, down to 60, down to something substantially smaller, and you have to be comfortable that your piece of the pie, even though percentage wise, ownership wise, is much smaller, it's going to be worth a lot more. And that's the trade-off. And so the first thing you have to think about is, how much of the company am I selling? And it's a lot. It's expensive. I just want to be very, very upfront about that. The other piece you have to think about is, and whether this happens at the seed round or certainly by the Series A round, when you take other people's money, there's a certain amount of, I'd say, governance that comes along with it. You go from being the owner and CEO who calls all of the shots to having to answer to a board that's there for the purpose of protecting all of the shareholders, not just you. And so there's this very painful, I think it's very painful. I went through this myself, and I've seen this, countless times, investing is that there's a painful process that you go from being the owner operator, calling all of the shots, to really professionalizing the business and providing and bringing in a professional board. And all of those things are great, and it can be really additive for the business. But for some owners and for some founders, that becomes a huge psychological journey they have to go down. And so I always talk to the founders a lot about that part of it. I think the ownership change is painful. I think the role change is even more painful. And so those are the two big things that I think that people have to be thoughtful about if they want to take other people's money, whether it's from professionals that have funds and things like that, like what we do, or just other people's money. You have to be very thoughtful about what does that do to change you in your structure, and how much are you giving up in terms of ownership, but also what duty do you owe these other folks because they're putting money into your company. So I'll stop there and maybe let Andy and Chris comment.
So Chris and Andy, on that point, have you seen along the pathway as the relationship matures, where there's just a ton of conflict in terms of strategy and execution, and what looks like a great proposition looks like it's ready to go over a cliff?
Yeah, I mean, before I became a venture capitalist, I mean, I was the entrepreneur that took money from venture capitalists. So I was on that side of the fence, and to put a finer point on that, I was actually one of the entrepreneurs that was brought into a venture-backed company after the founder was asked to step down from CEO, which was probably the most contentious position I've ever been put in, where the founder was still a board member. He used to be CEO. They asked that person to step down, and I was brought in to run the company. So you can see, you can see how these dynamics can play out. And I think I learned a lot from that experience, but I think there's a couple of things to kind of tie a bow on this. One is, as you raise more rounds, you become an employee of your own company, right? The board is now essentially your, bosses, if you will. Even though you're one of those board members, you become somewhat of an employee to your own company. You have a massive responsibility to those shareholders that you took money from. And when you think about, if you think about the number of funding rounds you could go through, Chris and Greg mentioned, there's a Series A, then a Series B, a Series C. When we're all hunting for what they call unicorns, right? These billion-dollar companies that Greg mentioned that drive the returns for the entire United States, those founders of billion-dollar companies, they likely have 5-7% of ownership when this company gets to an exit, right? So I think it's really important to remember venture capital exists for those companies that can grow so fast that 5% ownership is worth way more than 100% ownership. But when you do that, you become an employee of the company. And it sounds weird to say that, and that's maybe not the best way to say it, but I just think it's a mindset you have to kind of get into.
Yeah, I'd say the other analogy that we've sort of found is like when you're looking at investing in startups, it's sort of like dating. You have to date the company, date the entrepreneur, get to know them, and then when you invest, you get married, and then in a successful marriage, there's give and take, and you really need to be comfortable working entrepreneur for 5, 7, 10 years, because obviously divorces happen and things become contentious, and you really need to have a sense of trust, understanding, and work well together. There's a big personality fit that make up successful companies. Typically, you don't want to be like Andy and replace the CEO. That's very disruptive and not a great. Typically, doesn't lead to great outcomes.
Chris, for some people out in our audience who might be thinking, I might approach a VC for funding. Can you talk a little bit about what that individual might want to think about in terms of preparation, going about the process? Chris, how would someone go about that? Maybe Andy, you can jump in.
I think there's
picking the right fund.
Yeah, exactly. So that's the thing. So there's like
really
Andy touched on, there's funds that focus on healthcare. There's funds that focus on biotech. There's companies that focus on consumer products. So you lay that over the size of the fund also, right? So if you're looking for a $500,000 or $1 million investment, coastal investors that manage $1 billion, it's too small for them. So you have to find the fund that's looking for, likes your sector and that's willing to write, checks that are appropriate for your size. And typically the way you can figure out the size of the check is, we're a $27 million fund. We want to have a portfolio approach. So we're going to invest in, 15 companies. So, 15 divided by 30, 27 million bucks, sort of is the check size we will write. And likely that's not the first check. So maybe divide that by 2. So it's somewhere in there. So you really you don't want to waste your time and a venture capitalist time, trying to hunt down and chase down a VC that, is never going to write a check or invest in your company to begin with.
Yeah, I think what you hear a lot is, oh, you're just too early for us. You're too early for us. I mean, Greg's had to say it 1,000 times, I'm sure, and we've had to say it ourselves. And most people are like, well, what does that mean? So usually that means you're talking to a fund that has to write a check size bigger than what your company justifies today. So, if you're doing 10 million in revenue and you're growing at 100% year over year, yeah, somebody needs to write you a really big check. But if you're doing less than $1 million in revenue, and your growth rate is not doubling every year, then the check size is way smaller. And it's a totally different discussion. So I think, to Chris's point, step one, you got to find the right fund. And just so everybody knows, our funds have to be very specific. Our investors mandate it. So if you look at, I think somebody mentioned SWIB as a typical, not a typical, but they're an institutional investor. They invest in dozens or hundreds of venture capital funds. But when they do it, they're very specific. They say, okay, we want so many software funds. We want so many biotech funds. We want so many, hardware, life sciences, consumer. They diversify their own money. They don't want us to diversify it for them. So you really have to make sure you're talking to the right investors. And the best way to do that, in my opinion, is you go look at Crunchbase, you go look at PitchBook. They have free websites that you can get basic information. You have to use their paid versions to get advanced information. But you can get a general sense of the check sizes that Rock River Capital's written into our portfolio companies. You can go to our website and see who our portfolio companies are. So just with those two pieces of information, you can figure out, hey, these guys, I need a 500K check. These guys tend to write $1 million checks. I wonder if they'll do that or if they're going to tell me I'm too early, right?
I guess the other thing too, it's like another great resource for Wisconsin entrepreneurs are, the Wisconsin Tech Council is sort of a public-private, group that helps entrepreneurs raise capital. Generator runs great programs. Typically they're free. Their G Beta program is free. They run on, webinars, conferences where entrepreneurs can go learn about this stuff and get connections. Milwaukee Tech Hub and Milwaukee Tech Coalition is another great one. So there's different organizations in Wisconsin that'll help entrepreneurs learn about this stuff as well and give coaching, advice, and mentorship. And all three of us, we participate in those programs. We chat, similar to what we're doing right now, chat to educate the ecosystem. And then selfishly, it's for us to help help ourselves find deals and find investments and, find that diamond in the rough or find that company that's, exhibiting high growth or high growth potential.
These organizations that you're referencing, like, would they help an individual understand how to prepare and put together a pitch?
Yep. Yeah, they definitely would. There's definitely, seminars and definitely webinars, and, they've got sample pitches. I know Generator definitely does.
Generator's probably got the best format, I would say, for a pitch deck. I mean, Sequoia, you can actually Google it, a well-known venture capital firm out of Silicon Valley named Sequoia released their pitch book template, which is, hey, start with the market, start with the problem, start with the solution. They have a very specific recipe and format, and Generators kind of tailored that. So I think they're pretty open about that, getting that template.
And I'd also say, as I mentioned, it's sort of a dating process.
Yeah.
Raising capital from venture capitalists, probably takes 3 months to a year. I mean, there is you don't just meet an entrepreneur and write $1 million check in 2 weeks. I mean, you theoretically can, but I think you want to see the entrepreneur and see how they do, what kind of results, how fast they're growing, even at our early stage before they, before we invest, we want to say hey, what are you going to do? And then see what have you done, over the course of 3, 6, 12 months.
Just to add one thing, and it's less about some of these other groups and whatnot, but the biggest difference between the Bay Area and some of the really mature ecosystems and places like Wisconsin is there's just in the Bay Area there's a plethora of folks that have gone through this process that are now mentors and can really help guide new younger entrepreneurs through the process. And that's invaluable. So the difference in preparation of folks that grow up in those ecosystems is they're just so mature and they're so knowledgeable out of the get-go. And so that is a hard thing. That is a hard problem to solve for in the communities where we invest. But I will say that, in a perfect world, you spend a lot of time, looking at the resources that Andy and Chris just mentioned. But if you can find an entrepreneur that's gone through this and that can help guide you and provide some insight, and there's a lot of resources out there. There way more today than there were 10 or 20 years ago. Now you can really start to put together all the pieces just online as far as what I need to do and where I need to go to. But having somebody that's been through it that can kind of walk you through the subtleties and also be there emotionally and psychologically for the ups and the downs of the process, that's probably the biggest thing that's missing in a lot of these ecosystems. And that there are people that have done it. It's just there's not as many. So if you can spend the time to try to find and network to people that have had anywhere from a somewhat to a very successful company building exercise, that'll pay for itself in spades.
Yeah, so I want to move over and take a look at the chat here and invite some of the questions. So I think we all have access to that. I'm going to take a read through here. So the first question is from Jeremy, and this is for you, Greg. He says, Greg, I run a founder fest quarterly in Milwaukee. It's a couple 100-person meetup of founders from across the region. I've interacted with some early stage VCs that tell a lot of founders that they are too early. My question is, what isn't too early? Is it a revenue? How do you know when the right moment is the question from Jeremy. Greg. Greg, you're on mute.
You're on mute, Greg.
Sorry, you'd think I'd have that perfected after doing this for a couple of years. Yeah, I think Andy, talked about this. Some of it is you got to find the right fit from a fund perspective, but even within fund to fund, within funds, too early is can mean different things to different funds depending on some people are very much they'll invest if you hit a certain metric. And they'll always invest if in that case. And other people are more focused on the team and others are more focused on the market. And so when people say you're too early, they typically mean that you don't have enough proof points for their criteria, but their criteria is going to be different than, the next fund over. And so it is a little bit of a kind of, got to hunt and peck out there and try to find a good fit. But, there are people that raise big A rounds just off of who they are and what they've done with no plan and no business at all, because people know and have confidence that these people are going to figure it out. And other people have to go and build a real business with a real product and real revenue and have a lot of it before people have confidence in it. So it really depends. It's opportunity by opportunity. It's fund by fund. So there's no good answer. It just depends on who you're talking to. And it's not an easy process.
Thanks, Greg. And Jeremy, thank you for sending that question in. Let's go to the next one in our chat. This one's from David. And Chris, I'm going to pick on you for this one. More of a general question. Can you comment on the industry sectors that you believe are high demand or scalable growth exists right now? What the sectors do you think are on the cusp of great growth, Chris?
Well, I mean, So obviously software is done well. We continue to think software, whether it's AI or machine learning or, autonomous vehicles. There's, I've talked to a VC who's looking at space investments. It's trying to find the next frontier of, disruptive. When it's going to disrupt the status quo. There's a lot of, insure tech companies trying to disrupt the insurance industry. If you think medical devices that help, cure cancer, biotechs that, cure a disease. There's all sorts of different things.
Thanks, Chris. Hey, Andy, we're going to bounce over to you for Tom's question. What type of covenants does ROC typically require with their investments?
Yeah, so covenants are stated essentially in the investment documents. Those investment documents, there's nothing creative in them at all. We basically take them from the NVCA, the National Venture Capital Association, or we take them from RCEDC.org. Is that right, Chris? Sure. Basically, these are national standards for investment, and we use those national standards. And we do that for a couple of reasons. One is we don't want to layer on anything unnecessary that would overburden the entrepreneur. We want to do just enough to protect our investment, and that's it. And second, we want to make sure that we're not doing anything in the state of Wisconsin that wouldn't be widely recognized in the state of California. So if you want to go raise $100 million Series C from somebody in California, they're going to look at our documents and say, yep, that's exactly what we would do. There's nothing strange with this company that we have to fix. If you'd like to go read all of those covenants, it's NVCA and SeriesC.org. We don't make any new ones up.
And I'd say those covenants are less focused around, they're not like bank covenants where you have to have a certain revenue, hit a revenue target or hit an EBITDA target or have a leverage target. The covenants sort of restrict the entrepreneur to do, things we call unnatural acts that, they can't, change what type of business they're doing without board consent. They can't go raise a bunch of debt. They can't necessarily sell the company without, our consent. It's sort of things that just kind of keep the company going in the direction we all thought it was going to go in when we made the investment.
That's right.
Great. Well, I've got my eye on the clock here, and sadly, we're about to wrap up here. I could do this all day. This is just so fascinating. So I want to first thank Carolyn for setting us up with the landscape review that she did. And Greg and Chris and Andy, we really appreciate you joining us this morning and really engaging with us. What a great discussion. This is such an important topic, and we value your time with us. So thank you for joining us. A note to all our attendees, this event has been recorded and will be delivered to everyone who has registered. And I'm noting that we didn't get through all the questions in the chat, and call out to Jenny. Maybe we can respond by email to those who have asked questions that we did not get to. We will include our speakers' contact information. So Greg and Chris and Andy, you might get a few questions directly from our audience. So thank you for allowing us to do that. I have a big shout out for another event this week. So I hope to see many and all of you, hopefully. This Thursday is our big annual meeting. This Thursday, April 14th. This is an in-person networking event, but the program can also be viewed online as well. Local leaders will be honored. We'll do a brief review of 2021. And Hamza Khan, who is our keynote speaker, will focus on the future of work. And I've been watching his presentations on YouTube. He's going to be sensational. So if you haven't registered for our event, this is an action call to you. Please do so by visiting RCEDC's website. We'd love to see everybody there on Thursday. Also, a note for your calendar. Our next Leadership Council meeting is scheduled for July 12th. That'll be here before you know it. More information about that event will be shared in the coming months. Thank you again, everyone, for joining us, and have a great rest of your day.